Welcome to YieldNerd, an educational show about how you can acquire and manage yield. All right, yield nerds, thank you for listening and welcome back to the third part of Municipal Bond Deep Dive. I will say we have some very exciting things that we're going to be reviewing. One of them is taxes. Now, if you thought, how the hell can taxes be exciting? You just wait, we're actually going to have a Super Bowl. Trust me, we're going to have a real Super Bowl of yield, and I call it the Yield Super Bowl. So we have a lot of exciting things coming up. We're going to be talking about the tax implications for municipal bonds, and then we'll go around and actually buy a municipal bond in this part of the episode. Well, some of you may remember, depending on how far ago you listened to it, we put this thing called the happiness meter, and we kind of drove a really bad doom and gloom scenario and said, oh my God, you start federally taxing for this and federally taxing for that and state tax for here. It looked like municipal bonds were moving pretty far to the left, and we're going to try and make it move back to the right in this episode, and we'll see how successful we are, in which cases we are successful. Now, when it comes to taxes, you got to kind of educate yourself a little bit more. And I'm going to try and do that for you, but I want to make sure I give you a very, very clear message. I am not your tax accountant. I am not a tax consultant. This is education, and my usual disclaimers apply. Well, we left the municipal bond yield curves. We touched upon it earlier, and you may remember there were three curves we presented, which is for the AAA, the AA, and the single A. And these are credit ratings assigned by entities that have a job, which is to try and understand how creditworthy a municipality is, and then they reassess them, and so on. So these three generally represent the creditworthiness of a municipal bond, and we admired the fact that the municipal bond yield curve did not have a huge inversion. In general, it goes up, and that in effect is what you would expect, and that way it's positive. But I wonder how it would be if we overlaid this on top of the treasury and agency yield curve to see what is the better option based on each duration. And if we were to do it as you see here, it would be a blunder. Meaning, if I just took the raw treasury, which is the yellow curve, the agency, which is the blue curve, and threw it upon the AAA, the AA, and the single A and said, holy moly, this looks terrible. It looks like we should all buy agency bonds and not even look at municipal bonds. That would be terrible. And there is a very simple reason for that. Remember that municipal bonds are not federally taxed in general. Now, there are exceptions, and we reviewed 9 of them, but municipal bonds are not federally taxed. However, treasuries and agency bonds are federally taxed, and they are not state taxed. And so, what we really want to understand here is what happens when we bump up the yields of the municipal bonds. So we get a picture of pre-tax yield for treasuries and pre-tax yield for agencies and pre-tax yield for the munis, and kind of compare them on an apples to apples basis, if you will. And so what we are going to do is understand federal taxes a little bit before we start bumping it up by a random number, and then work backwards and start messing with our yield curves. A note on federal taxes: everybody says, I pay a certain amount of tax, and in reality, they are using a combination of terms. The United States tax code says that the first certain amount of income is taxed at one rate, the next certain amount is taxed at another rate, and so on. And many people refer to, when they say, I pay so much in taxes, they talk about their last dollar in income. Let me explain that a little bit more. And we're going to use the 2022 federal income tax brackets in order to do that. Suppose there was a married couple who filed jointly, and they reported $100,000 in taxable income. The first $20,000 of income would be taxed at 10%. The next 20 to 83, which is roughly 63,000, would be taxed at 12% and so on. And here I've shown what their income is and what their tax is. And if you kind of look in total, their blended tax rate is 13%. However, their last dollar is taxed at 22%. So this last dollar tax is commonly referred to as the marginal tax rate. However, this family actually paid a 13% tax on their total income of $100,000. Let's look at another example. This time we'll look at a couple that has much more in resources. It's a married couple who has 400,000 in income and they are filing jointly. And if we go through these tax brackets, you will again see that on a blended basis, this couple pays 22% in taxes. However, their last dollar was taxed at 32%. This is at a federal level. This is not yet the state or local tax, but this kind of gives you the picture of what the blended tax rate is and what the marginal tax rate is. And when we start assessing municipal bonds today, some may argue differently, but when I think of my own finances, I do not use the marginal tax rate. And the argument in terms of tax adjusting is something we will get into when we go a little bit later. But I'm going to be focusing on the blended tax rate, and we'll see what that means. And so, what I'm going to suggest right now is that you pause the video and go find your federal tax returns for the previous year. Pause it right here. I will wait. Let me know when you have your tax returns for last year. All right. I'm assuming you found your federal tax return for last year. Go ahead and open it up and find the line that says taxable income. It may be in line 15. For some of you, it may be in line 17. You will figure out where it is based on the type of 1040 you file. But write down or note down in a calculator anywhere your taxable income. Next, you're going to turn the page. And on the next page, somewhere there, you are going to see a line that says total tax. Write that down. So you've written down your total income and your total tax. Divide your total tax by the total income. That is your blended tax rate. Your blended tax rate is approximately what you pay for every dollar you earned in aggregate. We're not looking at the marginal tax rate here. We're not looking at the last dollar. You're just saying, if I put all of my money into a bucket and this is the amount of tax I paid, what is my tax rate? Some of your tax experts will tell you that you should be using your marginal tax rate, meaning the very, very highest number tax rate, because that is the last dollar. And I would very humbly submit, who is to say that the yield from the municipal bond is the last dollar and, your tax deduction is the first dollar? None of that. You can't tell the difference in your bank account which dollar came from the municipal bond interest and which dollar came from your salary. Maybe you can see a deposit, but once the money is in there, when you go to buy groceries and you pay with your credit card, are you really telling me that you're only spending your salary until your salary runs out and then your credit card magically knows to extract the municipal yield income? I don't think so. So I'm going to very humbly disagree with the generic point that is used by many people that uses municipal bonds and their interest and compares them or credits them towards having a tax advantage of the marginal tax rate. Instead, I'm going to use the blended tax rate. For the sake of argument, and we're actually going to see three different tiers. We're going to see a number lower than 20%, a number higher than 20%, and a number at 20%. So for the next few minutes, we're going to use 20% as our plug number. You already have your exact number, and I'm going to show you how to use your number in order to do the same arithmetic as well. So we're going to use 20% as that example. For Illinois, we're going to use 6.25% as our state's tax. For your own state, you may want to go find out what your state's tax is, and if you have any local taxes, and add those as well, and I'll walk you through where you need to plug in those numbers. So we're going to use 20%, and we're going to go back to that same municipal bond curves. Remember, those were the curves that looked nice and straight, and this was before we did anything to their taxes. We knew that we were going to get a break from federal taxes, so we're going to go back there and assume for a moment that every single dollar of your municipal yield is protected and you don't have to give back, meaning there is no de minimis, there is no discount, there is no modified adjusted gross income. So we're going to pretend that we live in the best of all worlds in terms of municipal bond yield, and we're just going to tax adjust it. What do I mean by that? We literally are going to bump up the yield every single point, every single duration. We're going to bump it up by 20% and say this is our hypothetical examples placeholder federal tax, blended federal tax. And so we're just going to say, well, if only I had bought a municipal bond, then I would not have paid federal tax. Federal tax is 20%, so this is the same as having 120 cents on the dollar I have in my bank account, because in the dollar I have in my bank account, I pay 20 cents of federal tax. That's the simple argument. So we're going to take that tax adjusted muni yield, and we are going to compare it with treasuries and agencies. Wait a second, we can't compare it exactly against treasuries and agencies as is either. Do you remember? Treasuries and agencies are state and local tax exempt. So what we need to do is take the treasuries and agencies and we need to bump that up by 6.25%. Now, as I indicated, you would need to find out what the state tax is and local tax is in your area, and you will need to plug in that appropriate number. So owning federal, treasuries and agencies is going to give you a state tax advantage of 6.25%. In our hypothetical example, munis are giving you a federal tax advantage of 20%. So we're going to take our treasury and agency and we have bumped it up already by 6.25%. And we are now going to have some fun with it. We are going to overlay the tax adjusted, meaning pre-tax yield, federal, state, local, pre-tax yield of treasuries, agencies, AAA municipal bonds, AA municipal bonds, and single A municipal bonds, and put them all in one page. And now that we put them all in one place, I'm going to give this a very special name. Introducing the Yield Super Bowl. This is no ordinary event. In the blue corner, we have the federal and the agency bonds. The treasury bonds and the agency bonds have been bumped up by state tax so we can get the pre-tax yield. And that is on one side, and they have George Washington on their side, and they will be playing against, in the red corner, none other than the municipal bonds, the AAA, the AA, and the A, all playing together. And in their case, we're going to bump up their yield by our current plug number of 20%, so we can understand how those two fare against each other. Let's get going. Thank you for listening to YieldNerd, a do-it-yourself show for yield accumulation and management.